Joining us right now with more on big tech and the broader markets is Meera Pandit. She is global market strategist at JPMorgan Asset Management. And Meera, trying to figure out what to do with stocks right now is pretty confounding. The quarter stunk for all three of the averages. They were down anywhere from 3.6 to 7.1% for the quarter. And you have this headline risk that comes out of the Middle East at this point. How do you separate what's happening in the Middle East, the global concerns, the potential threats with the fundamentals for what stocks are doing right now?
There are two major things going on in the markets right now. One is this tension between sentiment and fundamentals, which I think will probably be with us for the whole year because it was with us before the war. And while right now market sentiment is very sensitive to headlines, if you look at the fundamentals within the economy, if there is a war going on, nobody told earnings estimates, because you see earnings estimates for the S&P 500 going from 15% coming into the year to now 17% as we're on the eve of earnings season. So ultimately, it's actually looking like earnings could be even stronger than the prior 2 years when we had double-digit earnings growth. And a lot of the guidance you're getting from companies is still positive. Now, even if we see some of that revised back because of some of these challenges due to higher energy prices and higher input costs, you're still likely to end up with a year with very strong fundamentals paired with very sour sentiment.
So does that mean stocks look cheap to you at this point?
In some pockets, certainly. And what's been interesting, too, is while you see the VIX elevated and you see volatility overall high, you see single stock volatility even higher when you look at that constituent level volatility. So what's going on underneath the surface is it's unearthing a lot of different opportunities. You have about 58% of the stocks within the S&P 500 outperforming the index. And I know that's a relatively low bar, but that's still the highest share if we ended the year today since 2022 and 2010 before that. And usually what you tend to see in periods like this is correlations go up amongst stocks because everything goes down. But right now you're actually seeing relatively low correlations in the context of the last couple of years. And so that does create this environment for stock picking, even in sectors that are not doing well. I mean, financials is basically the worst performing sector this year, and yet you see 42% of stocks within that universe that are actually outperforming the index. So it does create some opportunities underneath the surface at the single stock level.
They're outperforming the index from a stock perspective or from an earnings perspective?
From a stock perspective.
From a stock perspective. I guess you look at the best performer in the Dow for the quarter, it was Chevron, up 35%. 10 out of 11 sectors were down for the month last month. The only one that was up was energy. And there is a real concern. Are these high energy prices going to continue? Because that will have an impact on many of these sectors. Industrials, I think, was the worst sector for the month.
Absolutely. So you have this shorter term sentiment challenge around energy, but you do have some of these longer term secular themes that are still playing out in the markets. I mean, you think about areas like industrials, materials, utilities. You still have this AI layer around infrastructure that's going to continue for many years. You look at some of the deal making that's going on, and it's still at the higher end, at the larger end of deals, prolific considering all the uncertainty out there. So there are pockets where the fundamentals within companies are looking beyond some of these short-term challenges. But I agree with you that, look, the bounce that we're seeing in markets right now could be premature. It could be a little bit short-lived here, because if you don't see free movement of oil and those prices coming down, that is going to be more of a longer-term challenge. But again, you think about a year like 2022, where that continued to be a persistent challenge, but eventually you did see some relief there. And while it took a little while for the rest of the markets to recover, it set us up for a couple of years of really strong returns.
When it comes to AI, what do you like? Because the other issue you can watch is the destructive force of AI. The worst performer in the Dow for the last month was Salesforce, and that's because of the concern that AI is going to eat its lunch. What do you like when it comes to AI and big tech?
Now it's about this infrastructure layer where we're moving from the big spenders of capital to the recipients of capital. And again, you're seeing that across a lot of the value-oriented sectors, whether it's industrials, materials, utilities, that power story, all the different commodity inputs. I mean, tech has very much shifted from a capital-light industry to a very capital-heavy industry, and there's a lot of inputs required in that. So that's where we're still seeing, even year to date, despite some of the challenges over the last month, some success in different pockets of the market where that trade is actually still going on underneath the surface. And I don't think we can necessarily ignore tech either. I mean, you look at some areas like the Mag 7, which went from 29x in terms of valuations at the beginning of the year, now to 23x. So we want to be mindful of what you already own in your portfolio and that exposure. But you're seeing correlations even within the Mag 7 drop pretty significantly. So now you do have that opportunity to pick and choose in the areas where you do think has a little bit more longevity, even within that tech layer. But it's really about the recipients right now in terms of infrastructure when we think about the AI trade evolution. And also international. If you look at the big star performers outside of the U.S., it's not China or India, some of the big behemoths. It's Korea, it's Taiwan, it's that AI supply chain level. You're seeing some of that in Latin America as well. And that's also where you're seeing a lot of earnings growth. It's not the dollar, it's not valuations. I wouldn't invest in international because those two things look good. Because last year we saw that. We're seeing the exact opposite this year. But that earnings growth has been an amazing anchor for investors, whether you're international and, again, whether you're in the U.S. That, I think, is our true baseline for the year in terms of how to invest when you have relatively poor sentiment. The sentiment can change, but that earnings growth is your foundation.